How do founders navigate complex VC term sheets? Imagine trying to decode a secret language that could shape the future of your startup. Venture capital term sheets are just that, full of details that can make or break your company. When founders face these documents, understanding what each part means is the first step. These sheets outline how much money is being invested, what percentage of your company the investor gets, and what control they will have. They also specify how profits are split if your company is sold or goes public. The first thing founders should do is learn the key pieces of the term sheet. Valuation is a big one. It shows what your company is worth before and after investment. This affects how much ownership you keep and how much the investor owns. Knowing this helps you see how much your ownership might dilute and what your share of future profits could be. Next is the investment amount and how it is structured. Will the money come in all at once or in parts? Will there be future funding rounds? These details influence control and your company's growth path. Liquidation preferences are another important part. They decide who gets paid first if your company is sold or liquidated. Some investors have preferences that let them recover their money before founders see anything. There are different types, like participating and non-participating preferences. Participating preferences can take a larger slice, which might limit what founders get. Control and governance rights also matter. These include how many board seats investors get and voting rights. They determine how much say investors have in decisions that affect your company's future. Anti-dilution clauses protect investors if your company issues new shares at a lower price later. But they can also reduce your ownership if not negotiated carefully. Founder and employee vesting terms might requiring you and your team to earn your shares over time. This aligns everyone's interests but can restrict immediate ownership. To navigate these terms, founders should first educate themselves. Know what each clause means and how it impacts ownership, control, and future options. It's wise to bring in experienced legal counsel and advisors who can spot unfavorable or risky clauses. Doing background checks on investors helps ensure they are trustworthy and aligned with your vision. When negotiating, be clear about your priorities. Push for clarity on vague terms and try to limit restrictions that could hurt your control later. Think long-term. Consider how these terms will affect future funding, your ability to make decisions, and your exit plans. Understanding term sheets isn't just about getting funding. It's about building relationships with investors who support your growth and share your vision. When you know what to look for, you can negotiate better deals and avoid surprises. This knowledge helps you protect your ownership, keep control of your company, and set the stage for sustainable success. Mastering these details makes you a stronger founder, ready to turn investment into a real partnership that fuels your startup's journey.